Costing methods provide organizations with structured approaches for determining the cost of products, services, projects, and other cost objects. Before costs can be used for planning, control, pricing, or performance evaluation, they must first be traced, classified, and allocated appropriately. Cost tracing involves identifying costs that can be directly associated with a specific cost object, while classification groups costs according to characteristics such as direct or indirect, fixed or variable, and production or non-production costs. Allocation and apportionment ensure that indirect costs are assigned systematically to cost objects. These processes create the foundation for accurate costing systems and reliable management information. Tracing costs refers to the direct assignment of costs to products, services, or activities whenever a clear and measurable relationship exists. Direct materials and direct labor are common examples because they can be identified specifically with individual units of production. Once traced, costs are classified to improve understanding and analysis. Direct costs are assigned directly to cost objects, while indirect costs, or overheads, support multiple activities and require allocation. Organizations then allocate or absorb indirect costs using suitable bases such as labor hours, machine hours, production units, or activity drivers. Accurate tracing, classification, and allocation improve cost transparency and support effective decision-making. Marginal costing is a costing method that assigns only variable production costs to products or services. These costs typically include direct materials, direct labor, and variable overheads. Fixed production overheads are treated as period costs and are written off in full against the contribution generated during the accounting period. The marginal cost therefore represents the additional cost incurred when producing one extra unit. This approach focuses on the relationship between sales revenue, variable costs, and contribution. Because it highlights incremental costs and benefits, marginal costing is particularly useful for short-term planning, pricing decisions, product mix analysis, and evaluating special business opportunities. One of the key advantages of marginal costing is its relevance to managerial decision-making. Since most short-term decisions involve changes in activity levels, contribution information provides valuable insight into the financial impact of those decisions. Marginal costing also avoids the complexities associated with allocating fixed overheads to products, making it simpler to operate and easier to understand. However, it has limitations because fixed costs are excluded from product costs. In organizations with significant fixed overheads, marginal costing may provide an incomplete picture of long-term profitability. Consequently, it is generally more suitable for internal decision-making than for external financial reporting. Absorption costing adopts a different approach by assigning all production costs to products, including both variable and fixed manufacturing overheads. The objective is to determine the full production cost per unit. Direct materials, direct labor, variable overheads, and a share of fixed production overhead are included within inventory valuation and product costs. Overheads are absorbed using predetermined rates based on budgeted activity levels, such as labor hours, machine hours, or units produced. Because inventory includes a share of fixed manufacturing costs, absorption costing complies with external financial reporting requirements and supports comprehensive profitability measurement. The choice between marginal costing and absorption costing depends on the purpose of the information. Marginal costing emphasizes contribution and cost behavior, making it highly effective for operational decisions and short-term analysis. Absorption costing focuses on full product cost and is generally required for inventory valuation and external profit reporting. When inventory levels change, the two methods can produce different profit figures because absorption costing carries forward some fixed overhead within closing inventory, whereas marginal costing expenses all fixed overhead immediately. Understanding these differences enables management accountants to select the most appropriate costing method for planning, control, reporting, and strategic decision-making.